Hello everyone, I am Lalit Kumar, Corporate and M&A Partner. I have with me Kumarmanglam Vijay. Kumar is our partner and Head of Practice Direct Tax. Today, Kumar and I will discuss the recent amendment made to include investments from non-residents within the purview of what is popularly known as angel tax. As you may know, angel tax is not a new provision in income tax law. It has been in existence for the last 11 years. However, it has drawn much attention after the 2023 Union Budget that proposed amendments to it. For viewers' understanding, angel tax is charged under the head of income from other sources upon the issuance of shares by a closely held Indian company on the amount of consideration received by it, which is in excess of the fair market value of shares issued. Previously, this tax was charged only on the issuance of shares to persons who are resident in India. However, with effect from April 1st, 2023, the angel tax net has been widened to include the issuance of shares to non-residents as well. As can be anyone's guess, this will have an impact on inbound investments in India, which is what we are going to discuss today. Kumar, before discussing the changes, if you could please explain what was the position until this amendment and how was the fair market value of shares determined?
Thank you, Lalit. As already mentioned by you, it applied only to closely held companies receiving investments from resident investors. There were a few exceptions, like in case of investments received by a registered startup on fulfillment of certain conditions, and investments received from the venture capital funds, Category 1 and 2 AIFs, and security funds. As far as determination of fair market value is concerned, companies could get valuation as per the adjusted net asset value method or discounted free cash flow method and opt for the higher of the two valuations as fair market value. DCF valuation report has to be obtained from a merchant banker. Companies could also substantiate the value of the shares before the income tax authorities based on the value of assets, including intangible assets such as goodwill, know-how, patents, licenses, franchise rights, etc.
Thank you, Kumar. This brings me to my next question. Could you please tell what will be the position going forward?
The major change is that now the angel tax provisions will apply to even investments received from non-resident investors. Having said that, it is interesting to note that the exemptions and proposed rules for valuation are not the same for domestic and foreign investors. As far as exemptions from the applicability of angel tax are concerned, the government has provided relaxation to eligible startups which receive investments from non-resident investors. Until now, it was limited only to investments received from resident investors. 3 classes of foreign investors are exempted. Government-related investors, including the central banks, sovereign wealth funds, and international or multilateral organizations, banks or entities in the insurance business. 4 categories of entities that are residents of specified countries. These are SEBI-registered Category 1 FPIs, certain categories of endowment and pension funds, broad-based pool funds with 50 or more investors, which are not hedge fund or a fund which employs diverse or complex trading strategies. The specified countries include Australia, Germany, Japan, Korea, UK, and USA. Mauritius, Singapore, and the Netherlands, from where substantial foreign investments are received in India, have been excluded. Foreign investors are also allowed to value shares using comparable company multiple method, probability weighted expected return method, options pricing method, milestone analysis method, and replacement cost methods. Safe harbor provisions permit shares within a range of 10% of the fair market value. A concept of price matching has been introduced. Where investment is received from an AIF, the subscription price is considered as the fair market value for the other investors as well. A similar price matching benefit is proposed for investments received from the exempted class of foreign investors as mentioned earlier. This price matching benefit will be provided only to the extent of consideration that will be received from these type of investors.
It seems an elaborate valuation mechanism has been provided, allowing flexibility in choosing a valuation method. Regarding its applicability, is it correct to say that all these changes are applicable only to unlisted equity shares?
Yes, Lalit. These are new valuations rules, and these are applicable only in respect of unlisted equity shares. For preference shares, the existing provisions would continue. The current valuation norms consider the price of the preference shares to be an amount that it would fetch if sold in the open market on the valuation date as its fair market value.
Now, coming to the challenges posed by this new rule. Since this is a new proposal, I am sure that there will be many ambiguities which need further consideration. Could you please share your thoughts on this?
Yes, you're right. There are many open issues that are not fully addressed. To take a few examples, the safe harbor and the price matching benefit are not made available for preference shares, which we all know are the preferred instruments for foreign investors like PE and the VC funds. I think that the 10% safe harbor may not be sufficient given certain commercial and legal rights which are usually sought by such investors, such as anti-dilution adjustment of conversion ratio based on the corporate action by investee company. Ideally, this could have been a higher limit, say 20 or 25%. Investors from popular jurisdictions like the Netherlands, Singapore, Mauritius, and Cyprus are not exempted. Specific condition of having more than 50 investors for broad-based funds would make it difficult for the feeder funds used for investment in India. There are a few interpretational issues in the language of the proposed rules, which we hope would get addressed in the final rules.
Thank you, Kumar, for your valuable insights. Undoubtedly, this is a big development. And as we go along, we can only hope more clarity will emerge to understand this tax better. Definitely, this is a space to watch out for.